Hi there, Robert Luft with Luft Financial. Today, what we wanted to go through is one of the most common questions that we seem to be getting from our clients in these periods of time where markets are reaching all-time highs. One of the top questions that we strive to help our clients answer is, how much should I keep in my short-term savings and my defensive assets versus my long-term portfolios? In general, you want to think of your assets as having two separate goals. This will essentially lead to two separate buckets of your money with two separate investment policy statements. Think of that like two different rules. Remember what the investment policy statement does for your investments with Luft Financial. This dictates the level of volatility that you're comfortable with and essentially ends up with dictating the assets that you're going to hold in that account. So, for example, for your funds that you might need to spend in the next 5 years, okay, it sounds like a long period of time, but there can be a lot of volatility in a short period like a 5-year period. So we call this your cash bucket. So this is going to hold assets in your investments like high interest savings accounts, T-bills, GICs, bonds, and mortgages. For your long-term portfolios, this is where you'll allocate funds that have a long-term time horizon, say of at least 5 years. And this would be according to your individual risk tolerance level. So say, for example, at least 60% equities. So let's give you an example of what I mean. Say you've got a $500,000 portfolio and you want to withdraw $25,000 a year. That withdrawal for someone means they're going to want to lower their risk of retiring right before, say, a major market correction. So maybe they'll keep $375,000 of that in what they call their harvest portfolio, their long-term portfolio. This would be their balanced growth investment policy with 60% equities. They then might have a separate account with $125,000 of the $500,000 in their cash bucket. That's the bucket we'd withdraw the $25,000 a year from. So essentially, they've got 5 years of stable cash flows put aside. If their harvest or their portfolio bucket makes money in a given year, they can simply take the growth from the harvest bucket and transfer it into the cash bucket. So what this does is it creates a degree of safety for your long-term withdrawals and removes some of the short-term risk that might be associated with unlucky timing when you happen to retire and start withdrawing your money. For example, say you retire right at the beginning of a bear market like the year 2000 to 2003. Now, this is a bit of a review of our cash bucket investment strategy. So what are the risks to this strategy? What are the risks, for example, that we take on with our short-term, low-risk investments that we hold? Well, there's really two main risks associated with your cash bucket. One is short-term interest rates, and two is the reinvestment risk. So what do we mean by that? The risk we face is that the interest rates fall on those savings accounts, or is, for example, lower upon renewal of our GIC. So if we're relying on this account to provide regular income, we need to monitor the interest rates and adjust the account accordingly based on current circumstances. Now, many people are forecasting, as you know, that interest rates could fall by as much as 1, maybe 1.5% over the next year as the Bank of Canada eases its interest rate policy. What this could mean would be lower interest rates on your high interest savings accounts immediately and lower interest rates on your GICs at renewal. So this has major implications, obviously, to this cash bucket. In other words, that the interest on these accounts is going to continue to fall. So currently, we're seeing our high interest savings accounts have interest rates of up to 4.5%. We're seeing 1-year GICs between 4.7 and 4.9%. But where will these rates be 12 months from now? So this low risk, interest rate sensitive portfolio that we've developed is really useful for funds that are not required over the next 12 months to 60 months. So in other words, over a year, but under a 5-year period. There is no equity component to this defensive portfolio for your cash money. There are no stocks. This portfolio, which we're calling our defensive portfolio, has three core asset class holdings: bonds, cash, and mortgages. And unlike our longer term portfolios with over a 5-year time horizon, this portfolio has no equities. So how does this defensive portfolio fit into your overall investment thesis? By adding a defensive portfolio to your cash bucket, for cash holdings of over 12 months, but under a 5-year time horizon, we can add more diversified income holdings that may respond positively in a falling interest rate environment. So, for example, if interest rates fall, a defensive portfolio that holds bonds will actually benefit. Those bond prices will rise, in other words, will go up when the interest rates fall. So this will offset some of the decreased income that you're going to get from the cash portion, the high interest savings, T-bills, or GICs, and from a declining potential interest rate cash flow from the mortgages. So while a falling interest rate environment will negatively affect the cash flows, we could actually see a capital gain from the rise in the bond prices in our defensive portfolio. So we can see that when bond prices decline, that would be a rising interest rate environment. So this happened, of course, in 2022. This was one of the worst years on record for bonds. Long-term bonds dropped in value when those interest rates spiked. So given the current environment, however, we may see declining income from these asset classes, so less yield from our bonds, high interest savings, and mortgages, but this could be offset if the bond prices rise in a falling interest rate environment. So unlike a portfolio for your cash holdings where we're just holding cash or GICs or high interest savings accounts, we may be able to generate a capital gain in a falling interest rate environment by holding this defensive portfolio for the portions of your cash account with at least a 12-month time horizon. So to reiterate, the defensive portfolio would really be a suitable option for you when you don't want to hold equity exposure and you have a time horizon of at least 12 months and you require income. So currently, the bond pool that we're utilizing has a yield of over 3.38%. In T-bills and cash, we're generating close to 4.5% and 6.24% from the mortgages. So overall, the yield on this portfolio currently stands at almost 4%. The bond portion of that portfolio has 12 different diversified bond holdings with bond managers, including PIMCO, Bank of Montreal, and Phillips Haggard North. So by allocating a portion of the portfolio to bonds, cash, and mortgages, we will diversify some of the interest rate risk affecting the savings or GIC portions of your financial plan. And as I said, currently this portfolio yields over 4% and will benefit from a declining interest rate environment in that the bond prices will rise. So let's try to summarize this. If my time horizon is under 12 months for the investments or assets that I'm holding, I would use a pure cash bucket. So if I might need all this money in the next 12 months, this is where I'm allocating cash in the cash portion of my investment policy statement. In other words, a GIC, a high interest savings account, T-bills. Now, if I have a time horizon of between 12 months and 60 months, but I'm still talking about short-term holdings, then I can use cash for a portion of it, but I can also use our defensive portfolio to try to increase the yield or potentially cushion myself from some reinvestment risk. That leaves your harvest or equity-based portion of your investment policy for all the money that you won't require in the next 5 years or 60 months. So I might keep 20% in my overall cash bucket, and of that 20%, I might have half of it in a defensive portfolio and half of it in a GIC or high interest savings account. In the example where the client has their $500,000 portfolio and needs $25,000 a year and has $125,000 in the cash portion, we might have 100,000 in the defensive portfolio and 25,000 in a short-term high interest savings account, which leaves the remainder for the long-term investment portfolio. So in summary, and with our defensive portfolio as part of your overall financial plan, use high interest savings or GICs for the cash buckets for money in your plan that you might need in the next 12 months. Consider a defensive portfolio for the portion of the cash bucket that you still want to remain low risk, but you have a time horizon of between 12 months and up to 60 months, depending on your risk tolerance. And this defensive portfolio will hold diversified bonds, mortgages, and short-term cash to help cushion the effects of a falling interest rate environment. At the end of the day, your allocation to defensive portfolios and cash is really a factor of your tolerance for variability when it comes to retirement. Some clients will want to have a 36-month cash bucket wedge, some clients up to a 60-month cash bucket wedge, with the remainder in their diversified balanced portfolio holding the equities. So depending on where you believe the overall equity markets and bond markets are going, this gives you some parameters for how to create a defensive allocation to your overall financial plan.